Welcome everyone in Finance for Engineers course. In previous lecture, we had discussion concerning the accounting principles that act as guideline for preparation of financial statements. It gives direction to the accountant while maintaining books of accounts and finalization of the same. Today, we are going to discuss on the various important questions concerning to finance. That is, what is the meaning of finance and financial management? What are the objectives of financial management, etc. The questions that you may thinking about right now are: why do we need to learn finance? Shall we not leave it to the people who are going to specialize in finance? Finance won't help me in the area that I am going to work in. So, why learn? This is to say that the knowledge of finance does not add any value to you. Is it so? Think about it. When you get your pocket money from your parents, you do not go out and blow the whole lot in one day, because if you do, your parents are not going to give you more money to last through that month. You quickly learn that you need to plan your expenditure so that the money lasts throughout the month, and you may actually plan to save some of it. Those who do not get enough to meet their requirements think about some clever means to raise more funds, more money. Alternatively, if they need more money for the month because of certain special event, they can plan to borrow money from friends for a month and repay in the next month. So you plan, raise, and efficiently utilize funds that are your disposal. That a business organization also needs to do the same. The scale of operations is much bigger, and to efficiently manage funds at this scale, decisions cannot be taken without any sound methodology. Finance teaches you this methodology. So now let us start our discussion on what is finance. Finance is also referred as the provision of money at the time when it is needed. A business needs finance to meet all the requirements, whether business concerns are big or small. All need finance to fulfill their business activities. Finance may be called as capital, investment, funds, etc. But each term is having different meaning and unique characteristics. Or finance may be defined as the art and science of managing money. So now let us see what is financial management. Financial management, as the name suggests, is the management of finance. That means it deals with planning and mobilization of funds that are required by the business organization. There is only one thing which matters for everyone right now, from the owner to the promoters, and that is the money. Managing of finance is nothing but managing of money. Every activity of the business organization is reflected in its financial statement. Financial management deals with activities which have financial implications. Therefore, it is rightly called as the integral part of overall management. The term financial management has been defined by the Solomon as it is concerned with the efficient use of an important economic resource, namely capital fund. The most popular and acceptable definition of financial management is given by S.C. Kuchel. That is, financial management deals with procurement of funds and their effective utilization in the business. Thus, it can be said that the financial management is mainly concerned with the effective fund management in the business. Now, you would agree that a company needs to manage its own funds efficiently, but your question still remains, why am I concerned with it? Further arguing, you see that I'm going to specialize in engineering, such as mechanical, civil, information technology, automobile, etc. And there is no need for me to learn finance. Also, finance is a separate function in the organization that I'm going to work, and I am hardly going to use finance to work in my respective department. Think again. Everything that you do has an impact on the profitability of the company, including drinking 10 cups of coffee in a day. So, if you want to grow up to be the CEO of the company in a few years from now, you should take the advice of the top CEOs given by KPMG survey. That is, 79% of the top CEOs rate finance skills as the most required for the CEO of the future. Better take the CEO's advice, but don't get the feeling that only these peoples require the finance skills. All other functions of management also cannot do without finance and the financial information. Therefore, you should know that the financial management is concerned with the procurement of funds. It is concerned with planning and controlling of the firm's financial resources, and they always try to raise funds at minimum cost and utilize it effectively to maximize the returns on the investment. There is a necessity to make a proper balancing of the risk and return trade off. Now, what is the key activity of the financial management? That is ensuring availability of lifeblood of the business. That is nothing but money. Now, we will discuss significance of financial management. The main objective of financial management is to make optimum utilization of all the available resources, which results in maximizing the profit of the firm. The success or the failure of business operations largely depends upon the financial policies pursued by the firm. The significance of financial management is discussed as follows. The first is determination of business success, optimum utilization of resources, focal point of decision making, measurement of performance, basis of planning, coordination, and control, and information generator for stakeholders. So let us see one by one. The first is determination of business success. C. Sound financial management leads to optimum utilization of the resources that are available for any business organization, and they are the key factor for successful enterprise. If we analyze the factors which lead to an enterprise turning sick, one of the main factor would be always a mismanagement of financial resources. Financial management thus helps the organization in preparation of plans for growth, development, diversification, and also the execution of the plans successfully so that the organization can achieve their objectives, their long term goals. The second point of significance is optimum utilization of resources. One of the basic objectives of financial management is to measure the input and output in monetary terms, which we have already discussed in accounting principles. Since finance managers are responsible for the allocation of resources, they are also responsible to ensure that resources are used in an optimum manner. In fact, the failure of business enterprise is not due to inadequacy of financial resources, but is the result of defective management of financial resources. In a country like India, where capital is scarce, effective utilization of financial resources is of great significance. The third point of significance is focal point of decision making. Financial management is the focal point of decision making as it provides various tools and techniques for scientific financial analysis. Some of the techniques of financial management are comparative financial statement, budget, ratio analysis, variance analysis, cost, volume, profit analysis, etc. These tools help the organization, help the managers in evaluating the profitability of a particular project. It guides whether the organization should accept a particular project or reject it. Fourth point of significance is measurement of performance. Performance of the firm is measured by its financial results. The value of the firm is determined by the quantum of earnings and the associated risk with these earnings. Financial decisions which increases earnings and reduces risk will enhance the value of the firm. Next point of significance is basis of planning, coordination, and control. Each and every activity of the firm requires resource outlays which are ultimately measured in monetary terms. The finance department, being the nodal department, is closely associated with the planning of most of the activities of the various departments. Since most of the activities of the firm require coordination among various departments, the finance department facilitates this coordination by supplying the requisite information. The results of various activities are measured in monetary terms. Again, the finance department is closely involved in control and monitoring activities. The next point, gives us an idea about the importance of financial management, is information generator for stakeholders. In this modern era, where business managers are working as trustee of public money, it is expected that the firm should provide information to the various stakeholders about the functioning of the organization. One of the major objectives of financial management is to provide timely information to various stakeholders so that by looking at this information, by analyzing that information, they can take important decisions concerning to their interest area. So these are the points which help us to understand about the significance of financial management. Next point of discussion is financial decisions. Financial decisions are the decisions that managers take with regard to finances of a company. These are crucial decisions for the financial well-being of the company. These decisions can be in terms of acquisition of assets, financing and raising of funds, day-to-day capital and expenditure management, etc. Financial decisions therefore affect both the assets and liabilities of a company. They can lead to profit, revenue generation, and receipt of funds and assets for the company. Also, they can be in terms of expenditure, the creation of liability, and an utilization of funds for a company. So, thus, you might have understood the significance of financial decisions. Everything you need to know about the types of financial decisions that are taken by a company. The key aspects of financial decision making relate to investment, financing, dividend, and liquidity, that is, working capital management. These decisions help to utilize the available resources for achieving the objectives of the organization. Unless minimum financial performance levels are achieved, it is highly impossible for a business enterprise to survive over time. So let us start with the investment decision. The investment decision is also referred as the capital budgeting decision. simply means the decisions to acquire assets or to invest in a project. What are the assets? See, assets are defined as the economic resources that are expected to generate future benefits. The very first aspect of capital budgeting decision relates to the choice of the new asset out of the various alternatives available, or the reallocation of capital when an existing asset fails to justify the funds committed. And the second element of capital budgeting decision is the analysis of risk and uncertainty. In simple words, capital budgeting decision is a decision to invest in long-term assets to improve the overall production capacity of the organization. They often require heavy capital expenditure. They need to invest huge amount for while purchasing any asset or investing money in a particular project, and they are for a longer period of time. Therefore, these decisions need to be made very wisely. Any commitment to such asset is irreversible. That is, we cannot take back once we take a decision of investment, once we invest money into a particular project or asset. And it leads to the blockage of significant amount of capital. In addition to this, return on such investments are very late and can take long period of time, over a year, before such an investment yields positive return. These expenditures include the establishment of a new unit or the expansion of an existing unit, the purchase or replacement of new machinery, investment in research and development, etc. The next decision is financing decision. The second financial decision is the financing decision, which basically addresses two important questions. First is how much capital should be raised to fund the firm's operations, both existing and proposed. The second question is what is the best mix of financing these assets? Financing could be through two ways. Debt. What is debt? Debt is nothing but the loan from various sources like banks, financial institutions, public, etc. And next is equity. What is the meaning of equity? It is nothing but a capital put in by the investors who are also known as owners or shareholders. So thus, shareholders are owners because the shares represent the ownership in any company. Thus, it can be said that financial decisions or these financing decisions refer to the decisions that companies need to take regarding what proportion of equity and debt capital to have in their capital structure. They have to work out a perfect balance between the two so as to maximize shareholders' value and profitability of the firm. Going for higher equity capital reduces the tension of repayment as they become part of firm's own capital. But then shareholders must receive higher returns in the form of dividend, and it will lead to dilution of ownership and voting rights. On the other hand, debt includes loan from banks, financial institutions, etc. Higher debt increases the interest burden and it makes the capital structure riskier. Furthermore, the company cannot rely on these sources of finance permanently, as lenders can reclaim their money at any time. Taking financing decisions is nothing but a continuous and ongoing process for a finance department, as each company regularly needs funding because a growing company's needs do not end continuously need money, rather go on increasing to keep pace with the growth. Now, the next decision that the firm or the organization has to take, or the finance manager is required to take, is dividend. Whenever a company makes a profit, it decides to reward its shareholders in return for their investment, trust, and confidence in the company. This reward is called a dividend. At the same time, managers must make the decision to retain part of the profit for the future needs of the company. This is known as retained earnings. Thus, finance manager has to take decision with regard to the net profit distribution. Managers have to make the important decision of how many portions of the profit the company should pay out in dividend and what part they should keep with them as retained earnings. Giving away higher dividend makes the stock attractive. That means it increases the market price of the share and the overall market value of the company increases. But they also have to take into account earnings and their stability. The growth prospects of the company, its cash flow statement, and dividend taxes, and above all, its own funding requirements, etc. So, this is also a very significant decision that the finance manager has to take. And the next important decision is liquidity or working capital decision. Decisions related to working capital is another crucial scope of financial management because short term survival is a prerequisite for long term success. Decisions involving around working capital and short term financing are known as working capital decisions. It also manages the relationship between short term assets and its liabilities. Now, what are the different assets come under the category of short term assets? They are cash in hand, receivables, inventory, short term securities, etc. These assets are also called as current assets. Then creditors, bills payable, outstanding expenses, bank overdraft, etc. are firm short-term liabilities, which are also called as current liabilities. Short-term assets can be exchanged with cash within one calendar year, and the liabilities are to be settled within an accounting year. Thus, it can be said these decisions are regarding the day-to-day operations and management of the company. Managers must ensure that the company has sufficient liquidity for its day-to-day activity. The managers must ensure that these funds do not dry up and there is no hindrance or any bottleneck to the day-to-day activities of the company. They must also decide on the various sources of short-term financing, and they have to prioritize the expenditure according to the availability and urgency of the fund. Short-term investment decisions also concern receivables and payables, as well as the acquisition and use of inventories. Thus, here we have discussed about the four important types of financial decisions that the finance department has to take. That is, the first one was investment decision, utilization of raised funds. Second is financing decision, which is concerned with raising of funds. Next decision was concerned with dividend decision, which talks about the distribution of net profit among the shareholders and retained earnings. And finally, last but not the least decision is liquidity decision, which is also called as working capital decision, is concerned with short-term asset requirement, short-term fund requirement, and managing it for the long-term survival of the business. Now here I'm ending my session, and in next lecture we will discuss the important aspects concerning to the financial management. Thank you.